Joining me now to discuss the impact of the meltdown in global markets that we just spoke about with Alistair and what this means for emerging markets is Manik Narain. He's an emerging market strategist at UBS. Thank you so much for joining us and a warm welcome to South Africa.
Thank you very much.
We do understand it is your first time visiting the country.
It is.
Hopefully a lot of myths will be debunked.
Yes.
But maybe let's pick up on the huge commentary for the moment. We heard Alistair just a moment ago say, stating the fact that we had a very significant sell-off in the markets last week. What does this mean for emerging markets like South Africa and its peers?
Well, what's fascinating about this sell-off is that it's happening within the context of big declines in US rates. So the market is sending out a signal here that US rates are no longer the dominant force in driving global volatility and therefore emerging markets. A lot of investors are still positioned for the idea that as long as US rates don't rise too much, markets like South Africa, India, Turkey, emerging markets in general, will see very limited volatility as well. But what we're learning is that actually if growth is starting to be called into question, which is what we're seeing through these moves in equities, commodity prices, break-even inflation, lots of different asset classes are sending out the signal, then global growth is a problem for emerging market currencies and emerging markets in general. So that's the message we're starting to see. Is
that unusual though? Because so often we think that the markets aren't moved by economic data. It's based on companies.
Yes, I think one of the reasons for that, for why that relationship might be changing now, as you say, is just simply how far we have already re-rated in global stock markets. So just to give you an example, European stocks, they're on a PE valuation metric, they are close to 15-year highs. So they have already strengthened a very long way on this promise of central bank liquidity expansion and very easy monetary policy. And from now, the markets seem to be, it's still at early days, but the market seems to be saying, I want to now see earnings, I want to see growth, because I have already re-rated a very long way. So it's possible that that's one of the reasons why this relationship is changing a little bit.
So if investors aren't necessarily optimistic about putting their money in equities, where are they investing?
Well, it's paid this year to be invested in US fixed income. A lot of investors have been arguing that the spread between German bonds and US treasuries is at about 15-year highs. So a lot of them have been putting their money into US rates, taking the view that the US economy cannot see huge increases in bond yields at a time when Europe and China and other major centers are decelerating. It may, the difficult answer may also be that cash is one of the more exciting options here.
Sure.
Unfortunately, what we've seen is that in emerging markets, despite a lot of promise, despite higher interest rates and diversification interest, the returns have been less exciting in practice than might have been the case in theory.
That surprises me because I thought for as long as the developed economies don't hike interest rates, their bonds might not be as attractive, hence the emerging markets would benefit from a bond perspective.
Well, emerging markets have benefited. They've actually, the counterfactual would have been even worse. Let's say US interest rates were 200, 300 basis points higher. Chances are that emerging market stocks, commodity prices, would have been much more challenged than they are today. So it has bought emerging markets time. But despite that, we've seen that growth, for example, in emerging markets is actually decoupling from the developed world. There's much more recovery in the developed markets than there is in emerging markets. And so, it's not as if lower US rates haven't helped. It's just that there's only so much that they can help.
Let's touch on that because you made mention of the fact that emerging markets is kind of living on borrowed time. When you zone into a country like South Africa, which has an extremely volatile and liquid currency, are we losing favor?
I think the risks are still skewed towards a weaker rand over the coming months. Yes, I do. Firstly, as I mentioned, growth is still a big problem, especially in Europe and China, which are South Africa's major export markets. The market has been very, very heavily invested in bonds in South Africa because real interest rates have been reasonably high and inflation, the short-term story is more encouraging. But the positioning is already there. And if we now start to see this higher volatility environment comes through, then you can expect to see that those bond inflows will slow down, and that would have some impact on the rand exchange rate as well. I find it quite difficult from here to see why necessarily even short euro against the rand is a very appealing prospect at these levels, given that Europe, the positioning in euro dollar is now very extreme, and European rates at the front end are at very, very low levels. So for me, one of the pain trades here that we can start to see in terms of what the market isn't expecting is that actually the euro will start to outperform the rand from here.
What does that mean for other emerging markets, our peers like the likes of Russia, Turkey and Brazil, which often feature commonly with South Africa?
Yes, many of my comments there would resonate for emerging markets beyond South Africa. I think one of the South Africa specific issues is the positioning in the bond market and the very slow pace of rebalancing in the current account. But nonetheless, these issues are also very true for Turkey, Brazil. Russia obviously is in one of the worst places given its terms of trade is very heavily linked to oil. By contrast, some emerging markets that are doing a little bit better are places like India, where they have made a bit more progress on reducing the current account deficit, raising real interest rates, attracting more FDI into the economy. Unfortunately, that's still happening at a very, very slow pace in South Africa, too slow a pace for us to have confidence that the rand isn't going to depreciate more from here.
Sure. So as an investor and you're looking as to where you can allocate your funds, is it a slightly more difficult decision to make, or are there certain opportunities of value?
I think there are certain opportunities of value within emerging markets. So for example, we think that there's some of the more developed EMs, if you like, the places like Korea, Israel, Mexico. We think that these bond markets are giving investors a relatively attractive risk-reward payout. A few equity markets, places like Korea, for example, which are quite well linked to the US growth recovery, might be relative outperformers. But I would say on the whole, probably the safest bet right now is the dollar, despite the moves that we've already seen.
Ooh, that's not a comfortable, those aren't words of comfort to any South African, but clearly we have a lot of work to do. Thank you so much for joining us.